Hello, I'm Sam Stovall, U.S. Equity Strategist for S&P Capital IQ. In this week's Sector Watch, I reviewed my Outlook 2015 article, which you can read by registering for a 14-day free trial on www.getmarketscope.com. The year 2014 is coming to a close. The S&P 500 is up more than 12%, and 9 of its 10 sectors are in positive territory, along with 75% of its sub-industries. We therefore have reason to celebrate. But what do we think is in store for 2015? We forecast the S&P 500 to rise to 2250 by year-end, based on cycle trends and fundamentals. Since 1945, the S&P 500 gained an average of 16% during the third year of a presidential cycle and rose in price 88% of the time. We see the U.S. economy growing 3%, benefiting from a similar increase in consumer spending, low crude oil prices, a near 8% rise in capital expenditures, and a more than 12% jump in residential construction. Finally, headline CPI is likely to remain below 2%. A rate tightening cycle should start by mid-year as the U.S. economy no longer needs to be stimulated. We see Fed funds rising to 1.25% by year-end, pushing the 10-year yield above 3.5%. S&P 500 earnings per share should gain 8.6%, accompanied by a 4% increase in revenues. In all, we recommend that investors stay long, local, and lean cyclically. We prefer U.S. equities to international ones. And even though rates should rise, we suggest underweighting but not avoiding bonds, which are the only negatively correlated assets to stocks. In all, we think the bull market remains alive, but will probably increase its kicking. I'm Sam Stovall, and I'll talk with you again next week.